We have a management rating by Amit Ramani, the CMD of Awfis Space Solutions, joins us now to discuss Q3 results. Thank you so much, Amit, for once again joining us. You spoke to us at the end of Q2 as well. A much more improved performance coming in as far as Q3 was concerned. Can margins sustain at these levels, and what was the occupancy rate as far as Q3 was concerned? Where do you expect to end FY25 at in terms of occupancy?
So very clearly, the margin improvement is a result of our operating efficiencies, obviously better client profile, clear focus on making sure we have the right operating leverage, and all of these factors, including occupancy, have made a difference and made the margin improvement. Our guidance for the year was about a 1.5% improvement, and we are already touching almost 4% from 10.5% to about 14.7%. So I think the margins will continue to hold, in my view. Again, as I said, I won't want to comment on the future projections, but at least for the next quarter, we feel strongly that the margin will continue to hold. The occupancy, as we have reported in the past, the blended occupancy is at about 73%. And the more than 12 months occupancy, which are centers which are a bit more mature, is at about 84%. So I think both are continuing to hold well. And I think for the foreseeable future, we think the occupancy will hold. And we say that with a lot of confidence because we were looking to add about 40,000 seats this year. And this year, for the 9-month period, we have sold about 40,000 seats as well. So the pace of new seat addition and new seat sale is keeping in sync. So we feel strongly that the occupancy will be maintained.
Amit, you've been surpassing all your estimates on margins, you already said, versus estimates of a 1.5% increase. You've done nearly 4%. Even on the top line, I think your guidance was 30% plus. First 9 months, you're tracking 41% in terms of a top line growth. Are you going to end with a 40% kind of growth? And what would be the new seat count addition guidance for the full year?
Reema, I wouldn't want to comment on the future projections here, but I think while H1 was strong and H2 will be stronger, so that's the guidance I would like to give. We were looking to add for FY25 about 40,000 new seats, and we have 120,000 seats that are operational across 193 centers. We also have another 20+ thousand seats that are under fit out and another 20,000 seats that are at a letter of intent stage. So we have clear visibility of 135,000 going operational by March of 25, and we have another 25,000 seats which are either under fit out or under LOI. So we feel strongly that the next year also seat addition is going to be at least at par, if not better.
But just to end the year with, instead of 30% plus, can you, considering how strong H2 is, we should be at 40% plus top line growth?
The momentum will continue. Reema, again, I wouldn't want to comment on specifics here, but the momentum will continue. I think the seat addition, our bets in both Tier 1 and Tier 2 cities. We added Lucknow to our kitty. We have 18 Tier 2 cities. All the different bets that we had initiated once we planned out the year, I think have all done well. And I think as a result, the numbers are speaking for themselves.
Amit, what percentage of the total contracted portfolio comes up for renewal at the end of FY25? Typically, when you go in for a releasing or for a renegotiation of the contract, at what rates are they happening? Are they happening at par, higher or lower?
So I won't have Vivek the exact number, but typically every year I would say about roughly between 10 to 12 centers come up for renewal, right? Typical renewal cycle. Now, you recall our model, which is managed aggregation. And in a managed aggregation scenario, there is no rent as such. So it's more of a profit share, typically a 70-30 kind of a split. So that continues, right? That's how the renewal happens on those properties. On the straight lease, depends on the micro market. Obviously, in the micro markets where the base rental has gone up, then clearly we are obviously, given to pay that higher rental because the market governs the rental itself. And we are in a straight lease scenario, we will most likely match that market rental. Rentals have gone up. We this year did about 77, we will end up doing 77 million square feet of commercial real estate gross leasing, the highest ever in the history of India. Co-working itself will end up doing about 15 million square feet, the highest ever in, again, the history of co-working in India. So the market is very, very strong. And as a result, obviously, the rental rates have gone up as well.
Possible to put a percentage to the average rental increase? And secondly, say by the end of FY26, how many cities or centers will you be present in?
So I'll answer the second question first. By end of FY25, we will be close to about 220 odd centers and close to about 135,000 seats. We will be live across 18 cities and almost 60 plus micro markets. In terms of the rental increase, Reema, honestly, it is driven by every market is behaving a bit differently, but it is safe to say it has gone up by anywhere between 5 to 50%. I mean, there are micro markets in certain cities where the rentals have gone up as high as 50%, but the average, I would say, is somewhere around about 18 to 20%.
Understood that. Thank you so much, Amit, for joining us, giving us a sense of how Q3 panned out and what exactly is expected as far as upcoming Q4 and FY26 is concerned. Let's now slip into a short break. On the